Watching. Today I'm working more on my strategy and I'm getting ready for paper trading. My goal is to start paper trading next Monday morning. So right now it's what is it? Wednesday evening. So I have 5 days to get there. So before I get started, I'm going to go over everything that I've done so far, the outline for the project, where I'm currently at, and then finally what I'll be working on tonight. So, uh, here's the outline for the project. So I have two goals. My first goal is to beat the S&P 500 by a significant margin while staying market neutral. So the S&P goes up on average 6% per year. I want to do significantly better than that, 3 to 4 times that, and return 18 to 24% per year. And the second part of this goal is I want to stay market neutral. So there shouldn't be recessions or big bull runs in my model. It should, regardless of if the market's going up or down, the model should be giving consistent returns. And I plan to accomplish this by using a long short strategy. So you go long on things that are going to beat the market average. You go short on things that are going to underperform the market average. And then regardless of what the market does, so long as the longs are beating the average and the shorts are underperforming the average, theoretically you should be able to return money. So what does this look like? So I have data going back to 2011. It's containing everything. It's a really good data set. It's free. The link's in the description if you're interested. But it's a really good data set going back to 2011. There's no survivorship bias, so it contains all stocks that have been added to or dropped out of the market during that time. And it has all of them. So a really good data set here. But you don't want to train the model on everything. So first off, there's things like test tickers, like for the NASDAQ. Those aren't even real tickers. Those have values that are just placeholders that never change. So obviously you don't want to train the model on that. Also, ETFs have different price action than common stocks like Apple or Tesla. And so you don't want to mix those together. You want to keep them separate. So this model that I have is trained only using ADRs, which are foreign companies listed on the U.S. market, real estate investment trusts, and common stocks like Apple or Tesla. Then I'm only keeping the top by dollar volume, trimming out everything below $5 a share to cut out penny stocks. And what's the final thing? Oh, dropping out everything that's dropped over 50% in the last year. So, once I add a universe, the next step is to create a model using that universe. So it should be predicting something moving forward. Something like returns relative to the market, returns relative to sector, probability of a positive return. I'm actually using the Sharpe ratio, and then extend it out into the future some amount. And so I have a really good model. I'll show that in a second, why I'm happy with it, why I'm confident in it. And so the final step, once I have a returns model, is to implement a portfolio model. And so I've had quite a bit of variation in finding things that are successful. So rather than keep exploring this portfolio phase forever, I can explore this while the model's paper trading. So I'm going to create a bunch of different strategies that are based around my core strategy here. And during paper trading, I'm going to look at how the different strategies perform. So now let me get to the model. Here's the model that I got about a month ago. So the first iteration of the current model I'm using. So why am I confident in it? The first reason is these metrics highlighted in the red box. So the top metric is the information coefficient. This is giving me the predictive power of the model. The stock market has a notoriously low signal to noise ratio, so a good information coefficient generally for stock market models is 0.01 to 0.02, and that's what I'm using as my goal. Here you see I'm getting 0.047, and so it's well above the threshold. These next four metrics are telling me about the stability of the model, so you want something that's powerful, but you don't want something that's really powerful at its best but fails really bad at its worst. You want something that's stable. So for that, I'm looking at the standard deviation of the information coefficient, the information coefficient to information ratio, and the t-statistic. So the standard deviation of the information coefficient should be 3 to 13 times the information coefficient. You see here it's about 3 times the information coefficient, so that's good. Lower end of my goal, the lower the better for standard deviation. Information coefficient to information ratio, my goal is 0.03. The value here is 0.3, so larger by an order of magnitude. On an annual basis, my goal is 0.3. I'm getting 2.2, so again, larger by about an order of magnitude. And my goal for the t-statistic is 1.98. I'm getting about double that. So just on the metrics alone, this model looks really good. But a nice second validation is how this decile analysis plot here looks in blue. And so this is really the hallmark of a good decile analysis. The bottom 10%, the lowest decile, should be the worst performing. Top 10%, highest decile, should be the best performing. And each decile should be higher than the previous decile. This means it's monotonically increasing, which is exactly what we see. So not only are the metrics, I'm beating all of the metrics, but also the decile analysis looks perfectly monotonically increasing. So it's good on both of those. Now that's for a single model that's tested from mid-23 through the beginning of 26. So if I do a different model for every year, from 2016 through 2025, this is just known as a walk-forward analysis. Am I still hitting my metrics? And you see information coefficient and annual information coefficient to information ratio are above the goals for all years. So for these reasons, I concluded this was a good model, and I went ahead with trying to incorporate a portfolio strategy on this model. So when I started in 2023, it was really easy to get a portfolio strategy which worked on this model. Almost anything I tried yielded good results, low drawdowns, high positive return, high Sharpe ratio. So that looked really good. However, when I did this on the walk forward models, going back to 2016, you see it basically was underwater from 2016 through the end of 2021. It goes up a little bit at the end of 21, then stays flat throughout 22 and the beginning of 23, and it only starts to come up here right about the time that this one's beginning. So this all the performance here is from the same time region that this is from. And so what we can say here is that it's performing really well at later times, but it performs really poorly at early times. So I looked into that. I found that if I optimize the model for early times, so the beginning of 2016 through the middle of 2018, and then let that optimized portfolio strategy run on the rest of the time, it basically went down and then flatlined. So that's the opposite problem that I had before. And the problems with implementing a portfolio strategy with this model can be summed up as that. If it does well at later times, it does poorly on early times. If it does well on early times, it does poorly on later times. And there's nothing I could do to fix this. So there could be two reasons for this. One is the dispersion in the market. The number of new stocks being listed went way up in 2020. The rate of new stocks being listed in the market has gone way up since 2020. And also there's been a lot more participation from retail traders. Specifically in 2020 is with the stimulus check. So you see very clear increase in dispersion in 2020. So that's the first thing that could be causing it. This macro regime change. Another way we've had a regime change around the same sort of time is famously during the 2010s, interest rates were almost zero, and in 2022 they came back up and became non-negligible again. So there's these two different regime changes going on, and I think that's what's going into this model that's causing this issue. So I looked at the model, and I found a couple of things when I was looking at the walk-forward decile analyses. The first thing is obviously these aren't perfectly monotonically increasing. Some years like 2018, you see the top decile isn't even the second highest value, it's the third highest value. And then early on here, that's not monotonic at all. So that looks really bad. Another thing you notice is years where it's having trouble, like 2020, the spread is really low. So here it's going from minus 0.06 to 0.02. Not much of a spread. 2021, a year that it performs a lot better on, the spread is from minus zero point 0.2 to plus 0.15. So here we have a spread of 0.35, 35%. Here we have a spread of under 10%. So not only is it's not perfectly monotonic all years, some years the spread is a lot lower than other years. So I decided to try to get a better model. So I dropped out everything that had a coefficient of variation above 1 and a mean importance below 0.05. And I got this model here. And you see, if you look at the returns chart, this actually looks a lot better. So it seems like it did pretty well from 2016 through 2020. It failed from 2020 through the end of 2021. And then it went positive again. So that looks a lot better. I tried some different models. And so something that I found earlier is if I added mean reversion and volatility features neutralized to the sector instead of the market, that improved the model. So that's what I did here at top, added in those features while still keeping the features neutralized to the market as a whole. I added in new features that were neutralized to the sector for mean reversion and volatility. And this model actually is performing much better than the previous one. So you can see that most years the distributions look better. 2018 still doesn't look that well, look that good. But if you remember from this model, 2018 never looked very good. Oh, sorry, not that one. This one. So the fact that 2018 isn't perfect here is fine. And also it looks better. Here 2018 looks worse than it does in the new model here. So I decided that also the metrics are all better. And so I decided that this model is the one I'm going to go ahead with. Now I tried the same thing, dropping out everything that had a coefficient of variation above 1 or a mean importance below 0.05. And that's this bottom model here, and it actually performed worse. So I decided to just stick with this top model. Now when I'm implementing portfolio strategies on this top model, you see that actually I can find, so if I just add in a little bit of scaling, this is with, the only thing that's scaling the exposure here is the volatility. So don't let anything else have any effect, just scale up exposure with the volatility and you get this really good model. So I've been going through and changing things around a bit. I was looking at, can I find any pattern with the information coefficient scaling that changes the Sharpe ratio, drawdown percentage, or duration of the drawdown? And there weren't any clear patterns here. This is with the information coefficient scaling combined with volatility scaling. Now, I thought it would be a lot more robust if I only scale with information coefficient and the spread of the model, because that would give a... basically it would only rely on the model output to do the scaling. Volatility, drawdown, if I scale down from those are external parameters. So you could kind of implement them on anything. You don't really need a model. But I've found some things that look really good. So this is, that's optimized through 21, but like this one, for instance, is optimized only on 2016, and it seems like it does okay for the rest of the model. This one's optimized 2016 to 2019, and this looks really good. What's really promising is that it looks really good over this 2020 region. It does have the drawdown persists longer, but the returns don't go as low. So yeah, because I basically wasn't successful at finding a single portfolio strategy that was obviously better than the others, and because I have several different models, I'm going to go through and create strategies for these different iterations of models and these different portfolio strategies. And I'll end up with about 90 different strategies, and I'm going to test them all at the same time while I'm paper trading, and I'm hoping that this will help me dig more into what models are effective. Another thing with backtesting is I'm trading a new model each year. So I want to try training models only on recent data, uh, training it on all available data, and just like the walk forward, training models only up to the year. So, um, oh, and I was looking through here, how much validation data do I need? And I actually found the less validation data I'm using, the better the model performs. So, uh, um, the model performs better if I use less validation data. Why use any validation data at all? Free. Well, I've been learning how to lose a thing I never laid a hand on. No. Well, good Lord, Lori, I love you. Could it go more wrong? Let's see if I have that recorded. Info, model. That's not very helpful. So what if I just put volatility? Yeah. Early Sunday morning, have myself a piece of toast. Yeah, it seems like the exposure is decreasing linearly. I don't know, man. So let me go back to here. Where did the code go? Live on steak and refried beans. Do the things harder. Alright, so let's try this guy. So let's set 5 longs, 5 shorts, hold for 5 days, rebalance every day, look back, 60 days, 3 months. Smooth predictions true. Buffer multiplier 1.5. Let's just make it 2. Beta neutral. Target volatility 0.04. What if I just use a small volatility look back? Lower the monthly volatility. Take off drawdown, take off spread scaling. Diane, every cowboy's dream. Alright, let's see how that performs. The thing's outer. Think I'll stay. It's New Year's Day. Okay, so let's go through and make the models. Oh, so I forgot. When I was doing this yesterday, it came down to I have to pull the data first. So just short-term volatility scaling. It's a little too sensitive. Stay with me. So let's try a longer look back. 2-month volatility. Alright, so I forgot I put some to-dos. Determine optimal time period for validation. Okay, I did that. Redo analysis of portfolio strategies with walk forward trained with lower validation. Oh, yeah. Forgot I was gonna do that. No one knows this more than me. Now I come clean up. Did you say that I'll need you? Oh, if I didn't, I'm a fool, you see. No one knows this more than me. As I come clean out. Alright, here's that portfolio strategy I just ran. So it's not... basically, the problem is COVID. That is a big problem for the model. And it just doesn't do well during COVID. But here it's dropping to nothing post-COVID crash. So I don't know what to do with that. But this will be interesting. Oh, damn. There's a lot to do here. I forgot. So let's see actually first. Does 6 months of validation data improve trouble years? And the cranberry glades ain't got bars nor the charge to collar anyway. My mind's a mile a minute. My thoughts they bark like hounds. So we have 2018, 2020, 2025. The wishes she can hold. Okay, so we want 2018, 2020, and 2025. And how many validation years am I using? 2? Val months, train years, val years, test years. Train months, val months, test months. Okay. It's pretty easy. Advanced models. Has come and gone. All the snow has turned to water. Okay, so what? Oh yeah, okay. Save folder, run walk forward analysis. So then let's add here. Train months equals none. Val months equals none. Test months equals none. And then min train months. Okay, now we can run model 25 again. Test model 25. And now we can do it with min train years, val months is equal to 6. And that's it, right? Good, that should be easy. So we need 3 years of training data, 6 months of validation data. And then min train years. So I should probably change that to be min train months. We can just do 12 times 2, 24, so 30. 2.5 years. And this should work. I think it was 2 before. Oh, I could double check. So let's see if I didn't overwrite it. Look forward metrics, quick look. Yeah, so 2 years. So let's actually call this something different. So call it 6 months for 6 months of validation data. Now we can run it. This is taking a while. So here we can say 2 validation years. 2 years validation. Versus 6 months of validation. So this guy's still computing all the features. That's what takes most of the time. Okay, so I want to see, does this improve it? If this improves it, how does the portfolio strategy improve? But I gotta get it to, so the first thing we're looking for in 2016, it looks pretty monotonic, except for here. That's pretty slight though. But if that looked better and the spread became larger than 0.1, then we'd definitely be going in the right direction. So let's see, that's my goal. Increase the spread, make it more monotonic. Okay, let's so if we go back to Portfolio Explorer, if we do 10 longs and 10 shorts. Set target volatility to 0.12 over the last month. No drawdown, so only volatility scaling. Or what if I just take volatility scaling off? Hey Devin, I'm working on my stock market model. Let's see, let me run this, then I'll go over it really quick. It's still validating on a full year. Why is that happening? Alright, so here's where I'm at. Yes, I can, but the first thing I'm trying to get going is on the stock market because there's so much data. And then I'm going to expand it out into other uncorrelated things. But this is basically the outline for the model. So I have two goals. First goal, beat the S&P 500 by a significant margin. We'll stay in market neutral. So S&P goes up on average 6% per year. I want to do significantly better, 3 to 4 times that, and go up 18 to 24% per year. Also, I want the strategy to be market neutral, so it shouldn't matter if we're in a bear or bull market. the return should be consistent regardless of the macro regime. So the first step is isolating a stock universe. You don't want to use all stocks that are available to you. I've done that. I've trained a returns model. I'm confident the returns model is good. And then the final stage, which I'm working on now, is implement that into a portfolio model. And I'm kind of tweaking the returns model as I go. But there's not much utility in that. So now I'm working on the portfolio model. Here's the returns model. And basically I think it's really good because first off, it's beating all the metrics I'm going for by a significant margin on every metric. Also, the decile analysis looks perfect. So the bottom decile, bottom 10% is the worst performing. Top decile, top 10% is the best performing. And each decile is higher than the previous decile. That means it's perfectly monotonically increasing, exactly what we see here. And then when I did a walk forward analysis on this model, I'm beating the metrics, my goal metrics, for every single year. So for those reasons, I was very confident in this. I tried implementing a portfolio strategy. Basically, anything I did on the single model, which tested from mid-23 through the beginning of 26, worked really well. When I tried these same parameters on the full walk forward models from 2016 through 2026, it basically failed from 2016 through the end of 2021, flatlined in 22, and only started to go positive after mid-23, same time that this started to go positive. So there were several reasons this could be. The reason I thought it was because the model doesn't look perfectly monotonic on all years, and because the spread is changing significantly between years. So like 2020, for instance, you see the spread is about 8%. 2021, a year later, the spread is 35%. So pretty different spreads there. And what else? So I basically tried tweaking the model a bit. I was able to get a better model out. This top model here is the best one I've gotten so far. You can see the decile analysis metrics look better. The information coefficient and information coefficient to information ratio are slightly higher. And now I basically solved that problem where it does well on early years but poorly on later years, or poorly on earlier years and well on later years. And so this is what it looks like now. This is actually an optimized model. Generally, the problem I'm having with this current model is it does well over the whole time frame, but struggles during COVID. So you see a good example of this here. It's basically getting good positive returns, goes negative during COVID, and then runs up again. And that COVID regime is really weird. And so I think I might just have to settle on something that doesn't look optimal there. So that's why I'm trying so many different strategies. So I'm going to implement a whole family of strategies that are using slightly different models and slightly different portfolio strategies. And then I'm going to see, does anything, outperform the others over paper trading. Okay. Well, so much for that. Let's just switch over to the other one. So that I have an additional model to specify months instead, so that I have additional inputs to specify months instead of years for the validation data. I want to only use 6 months for the validation data set. But when I run the code with val months equals 6, the models are still training with a full year of validation data. What is the issue which causes this, and how do I fix it? Do not rewrite the whole function or script. Just give me the changes and tell me where to put them. Did I not save this? I think I saved it. I am a robotic engineering student and learning stock market to generate some money to making our project. I'm new in stock market, so we have no idea what you can do. Sorry for bad English. I'm from India. No worries, I can figure it out. So you're a robotic engineering student and you want to make some money in the stock market for what? What's your project? You're building a robot? All right. So we gotta wait for that to run. It might have been as simple as the save. Yeah, my project is hexapod with robotic arm. To do what? What do you want? What's the goal you're trying to accomplish with this bot? To use test M instead of current use. So I think that actually is it. Nope, that doesn't work. So let's see if this works now. Unless do I need to save Model Explorer? Alright, come on, let's see what this guy spits out. Alright, now I need to, before I can get to building those models, the base models, oh, I guess before I get to the base models, I need to define how many validation years to use. But I think we're on the track to going with 6 months for the validation set. Let's see. Okay, this should be almost ready soon. A hexapod is a research and rescue robot that goes into places where humans can't reach and collects data from there. But what makes your hexapod unique? What the fuck? So validation data. Let's see if anything's saved. Train start 2011 10/17, train end 2014 12/31, val start 2015 2/12. Okay. It's gonna drive me fucking nuts. For example, like the Chernobyl incident. Yeah, you don't want to send humans in, so you send a bot in. But what is this for? A project or something? Like, what's the goal with your project? How do you know you have something that you're happy with? At what point are you happy with your hexapod? Alright, so there's obviously still a problem here. Let's go through it. So when do we define the validation data? Val start is... Okay, so val start is defined somewhere up above. First val date plus PD months equals Alright, my phone should be charged enough. Let me get some music going. Okay, so this outputs something, but I don't care. I want the 6-month validation version. Give me some good music recommendations if you got anything I should listen to. I need some new music. Oh, new Professor Jang video. Do you guys like Professor Jang? I love this guy. He's the best. My professor. No, I'm not running run walk forward filtered. This project is for my college, and in a way, it's showcasing during participation in tournaments. Yeah, I know what you mean. I've done. I did one robotics competition before, so. Uh, I mean that those things are all networking, especially when you're a student. But you should. Dude, the applications are endless. You just have to think of one. I bet you could find some use case for your hexapod beyond search and rescue. I mean, because search and rescue is a use case, right? So what other? Let's brainstorm. What else could you use it for? Uh, I guess the benefit of a hexapod is it can move over any sort of terrain. I think that's kind of the trade-off, is it's a lot slower, but you can get over anything. Is that right? Okay, well, at any rate, I have to build the live trading infrastructure. Let's get into this. Now that I can see the code, you saw it before. That's right about hexapods. So, what else could you do? What else is something that's some really messy environment? Um, Obviously, you would say is disaster zone. I don't know. What else could it be useful for? Maybe you need another robot for different stuff. Oh, so I probably... The main reason for creating this project is that it will help me learn all the core applications of robotics. However, my final project will be a humanoid robot. That's what everybody's making right now. Why do you like humanoids? I'm not the biggest humanoid fan. I feel like I feel like you know, the human form is beneficial for some things, but I think we're too like narrow-minded when we want to use humanoid stuff for everything. But it is true, the world is built for human forms, so... That's fine. Let's see if this changes it. No, it says 6 months for the validation, but it's a year. Come on, man. This is killing me. Well, that is the last. So it says 6 months. What does that look like? Val. Alright, well, I could wait for this guy to train. And then I'll see what happens. Oh, you retracted your message. I want to create a humanoid robot because in the future, tasks like the ones people do at home, cleaning, food preparation, dishwashing, Yes, that's true. That's true, but if you the problem with the human form is it's so complex, and like if you look at humanoids, they use all those, it's almost infinite motors and control systems. Um, if you just have a box with wheels, that's way simpler. I think a big part of robotics is going to be the maintenance of them. Like, um, a robot's great until something breaks, and then it's just a really expensive chunk of metal that's sitting around. And so the only robots people will want to buy is if they can have faith. Unless they get way cheaper, I don't see that happening. So, assuming they cost tens of thousands of dollars, the only way to get somebody to buy one is if they can be maintained easily, right? But then with a humanoid, it's how difficult it is to maintain blows up exponentially. Yeah, I just don't feel too confident in humanoids because of that. All right, let's see now. Info. Okay, no update, but maybe if I exit out of here. No. Okay, model is thinking. Hey, Sir Night Night. It's going pretty well. I'm just going through and tweaking things. I found this morning that if I use 6 months of validation data, the bottom right plot, that's performing better than 1 year or 3 years of validation data. So now I'm going and I'm changing the walk forward analysis so I do the walk forward of the same model. I'm hoping here, like, I don't know when I'm what I think the test here is from 2023 through the end of 25 through the beginning of 26. Um, anyway, The decile analysis is a lot better when I do use 6 months for the validation set. So I'm going to go through and try to redo this model, see how it does on the validation set. I keep fucking up when I'm trying to rewrite the walk forward code. But once I get that to work, I'll have that comparison. And assuming it's better, I'm going to try some portfolio strategies. I have some strategies which look pretty good. Um, and I'm kind of minimizing the drawdown. Yeah, so basically the problem I've been having is it doesn't do well with COVID. So if I just optimize from 2016 for 2016 and then let it run the rest of the years, it does really well. And it does even better if I include, obviously it does better, but it does even better if I include COVID in that optimization range for the portfolio. So I'm going to try out a bunch of different models and portfolio strategies. They're all kind of similar. They will all be in the same family of strategies. But I just want to try out different things and see what works well, what doesn't. Um, and then I'll start paper trading. So my goal is to start paper trading Monday morning. So I need to finish all this up this week and over the weekend. So by detachable part, I mean I want to build a robot where, for example, if it has a hand, you could remove that hand. Oh, that's a pretty good idea. I like that. Replace it with a new hand. Each part will have proper instructions for attachment. That's the problem, is you can't have. I think the big money is going to be in building a macro robot to repair other robots, because nobody's going to want to read through instructions for the robot. If it's broken, they just want it. They want to go fix it, and then have the working version. New one from us and install it themselves. That's a kind of humanoid robot. I think there's really something to that, but then except for the part where people have to do it themselves, I think the way to go is you have a maintenance robot that's maintaining the robots. People wouldn't even have to buy that. You could just send it out to people's homes. And if it works every time, then, who cares if it's a robot doing it? So let me think. I could manually do it. Yeah, but then it's going to be hard to get the portfolio. Thanks, Sir Night Night. I'm from I'm from California, and I guess that's where I live now. So yeah, California, United States. I'm not using Jupyter Notebook. I'm using Anaconda in the command line to manage environments. Hey, yeah. Well, I'll post the. To keep me honest, I'm gonna, once I start paper trading, I'll either do a short video or a live stream. Yeah, let me know what you think I should do, actually, because I'm gonna post the picks every morning and then a summary at the end of the day with here's how we did today, here's how the paper trading's going. Um, do you think it would be better to do that with a post on YouTube, a video? I'm not gonna make a fucking video, but I could make a video, like a 5-minute video. Or should I just do it? I could just do it on my live stream, and at the beginning of the stream, say, or at some point in the stream, go over the paper trading. But I feel like if I do a little short 5-minute video, that would help me get more viewers. Anyway, one way or another, you'll have all the picks so we can see how it does together. I'm not using a Jupyter notebook. I'm using Anaconda. Could the problem that you identified still apply to my workflow? If so, how do I fix it? Pumped up feeling. Hey, thanks, Devin. You should have a comment section. You can post it. Live stream is better. Well, honestly, I could just do both. Just get the pics for the day, post it. It's just a screenshot of the terminal. Oh. Good night, Devin. Comment section on your channel if you don't want to stream. What do you mean comment section on your channel? You mean like on the post? Like the comment section on the post? Let's see how this does. Alright. We'll see if we could get the new walk forward. Alright, so either way I have to, Alright, so get data. It actually might be really easy. Oh. So this just reads the data set. I never even knew there was a community tab on my channel. I'm looking at it now. Community. How do I go there? Videos, shorts, live, playlist, posts. Oh, turn on my community. Oh, that's cool. Previously, my posts are all artwork, so this will be a change of pace. Dolt pull. I'm totally confused on this. Checking remote server looking for key association. Hey, thanks, Sir Night Night. Oh, yeah. Well, thanks. That makes me feel good. Whoa, this looks better for 16, so... Oh. So it looks better. But it's using 4 years for the train. So train, let's just use... 3.5 years. Or really I could use 2.5 years for the train. Min train months is 30. So how do I do this? So if so for the first one we have 4 years. I could change it to 3.5 years, and then it would validate. What a headache. So if I still want it to... Light it up, dead smoke and mirrors. $4 years. So even if we go one... So 1 year takes us to mid 16. You told me that they can't understand the man I am. Alright, let's think. So how do I do this? First, let's pin Sir Night Knight's comments. Understand the man I am, so why are we here? Alright, I have to think about how to do this walk forward. But I think that's going to be it for tonight. Thanks for watching. I'm going to keep working on this more tomorrow, so subscribe if you're interested.